Good morning, everyone. Today, I'm going to talk about a question that's been buzzing around financial circles lately. Is now the time to buy Japan? This topic has garnered a lot of attention due to the recent powerful rally in the Japanese stock market. But the key question remains, does this rally have staying power, or are investors just caught up in a compelling narrative? In late February, Nomura Securities, Japan's biggest brokerage house, did something quite unusual. They invited journalists into their headquarters, specifically to the equities trading floor, a place usually off limits. The reason? The Nikkei 225 average, a major stock index in Japan, had been on a powerful rally since January and was about to break its all-time high set in 1989 during the biggest stock bubble in history. When the record was broken, there was an eruption of applause from traders. This significant milestone suggested that Japan was emerging from its last decades of economic stagnation. By the end of March, foreign investors were starting to buy into the excitement, pushing the combined market capitalization of Tokyo-listed stocks to 1,000 trillion yen for the first time. Several factors make Japan an attractive investment destination right now. For one, geopolitical issues have made China less appealing for Western capital, shifting focus to Japan. Some analysts, like Pelham Smithers, highlights that Japan offers numerous opportunities in the tech sector, particularly for investors who feel they've missed out on US tech stocks. However, not everyone is convinced. Scott McLennan from Schroders warns that while the Japanese market is exciting, it's crucial to be cautious after a period of sustained strength. This sentiment is reflected in the performance of the Nikkei 2025, which has traded sideways since its epic breakthrough. Japanese companies have been making strides to meet investor expectations. Share buyback announcements have hit record levels, indicating efforts to return value to shareholders. Despite this, foreign investment remains relatively low, suggesting that global investors are still wary. Domestically, the introduction of an expanded tax-protected investment scheme, similar to the UK's ISA, aims to draw more of the best household savings into the stock market. Historically, Japanese households have held a significant portion of their assets in cash, a trend that might be changing. The Japanese government and the Tokyo Stock Exchange are working hard to shift this trend. Prime Minister Fumio Kishida has emphasized Japan's break from deflation and the need for households to hedge against inflation by investing in stocks. This change in economic policy could support long-term growth in the stock market. Recent investor conference in Tokyo, hosted by Morgan Stanley and CLSA, attracted a global audience of fund managers. The consensus among many attendees was that significant changes are happening in Japanese companies, driven by both internal reforms and external pressures from activist investors. The macroeconomic environment is also supportive. Inflation and wage growth are returning, and the Bank of Japan might raise interest rates soon. These factors, coupled with a shortage of labor across sectors, paint a bullish picture for the Japanese economy. Despite these positives, there are challenges. The market is bifurcated, with the stark contrast between large-cap companies and are shareholder-friendly, and smaller companies that lag in this regard. Additionally, while some investors like Warren Buffett have made notable investment in Japan, the overall enthusiasm among global investors is still tempered. In conclusion, while there are compelling reasons to consider investing in Japan now, it's essential to approach with caution. The rally in the Japanese stock market is backed by significant structural changes and the favorable macroeconomic environment. but the market's future performance will depend on continued reforms and the ability of companies to adapt to these new conditions. Thank you for listening.